Hello, this is Professor Randy Minton of Thomas University, and today I'm going to talk to you about an element of Chapter 8, and that is the income statement approach to the allowance for doubtful accounts, or the allowance for uncollectible accounts. And there are really, in this chapter, two elements that you really have to pay attention to. The first is this one, which is the income statement approach to the allowance method. And the second one is the balance sheet approach to the allowance method. And I'm going to have that on a different, the balance sheet method that is, I'm going to have that on a different video, and it's largely just to keep the overhead of these videos down to some reasonable level, because it takes a couple, 3 hours to upload them, even if they're only 10 or 15 minutes long. So, and that's probably why I speak a little bit quickly as I go through these. Now, even if you haven't been doing this in the past, what you really want to do in these accounting problems is you want to take a look and see what the requirements are. And in this case, what is the balance, starting right here, what is the balance in the allowance for uncollectible accounts if A, the beginning balance is a credit of $25,000, or B, the beginning balance is a debit of $15,000, what entry or entries are to be made? And I will tell you that one of the ways that you can quickly pick out whether or not you are being asked to do the income statement method or the balance sheet method is this thing with credit sales and then computing the losses based upon credit sales. If you're doing that, then you're working with the income statement method. And with the income statement method, the focus is going to be on the expense side. With the balance sheet method, you'll find that the focus is on the allowance side or the contra asset side. So in the income statement method, which we're going to deal with here, we're talking about the expense side. So I've gone ahead and I've actually plugged in some numbers so that you can see what happens here. And I've actually made these, given a little bit of thought to how these numbers work out, and I've created a pretty strong correlation between credit sales and the loss percentage. And if you don't believe that, I'll just do a quick little correlation for you. And all I'm doing is I'm capturing the loss side and the sales side and creating a correlation, and you can see that the correlation here is about 96%. To have a positive correlation between two numbers or two sets of numbers, you need something in the neighborhood of 51% or over 50%. In this case, you can see that it's 96%, so the correlation is just enormous. So we can say with great specificity here that credit sales and the losses are correlated. Okay? Now, why am I telling you that? Well, I'm telling you that because we have to now make a decision, and your book always does this for you. Your book always says, well, okay, the losses are 3.2% or estimated to be 3.2% or whatever the case may be. And, you know, I would say to you that that's not the way that it works in the real world. You have to figure out what that number is. So I'm going to look at this group of numbers in 3 different ways for you. And, you know, I've already plugged in these things basically, but I want you to kind of see the thought process that one might go through in order to come up with these numbers. So in the first instance, I would say let's just look at the weighted average of your dollarized losses and your credit sales. So if I do that, whoops, in the wrong place here. If I put a 1 in here, that automatically does that for me. So it's basically adding up all of these numbers from 11 through 2015, giving me a total, and it's doing the same thing over here. It does not include this number right here, which is the actual calculation of the current year's estimated, or 2016's estimated loss. Now, I want to point you to this number. It's 3%. And if I look down through these numbers, what I'm going to see is, let's just look at the ones that are over 6 million. And in this case, I'm estimating over 6 million. And you can see that that one was 4%, 3.6, 3.2, it's 6.1 million. So I'm not sure that 3% makes great sense in this particular instance, because it's below what we've seen on every other credit sales volume that exceeds $6 million. So let's come back over here and let's try the second one. And in the second one, what I'm going to do is just look at the amounts that are over 6 million. Now, that looks a little bit better, doesn't it? Because when I look at this, I see 3.6%. And here I've got 6.2 million, it's 3.6. Here I got 6.1, it's 3.2. 6.6 is 4.0. And I could stop right there and I'd have a fairly decent estimate of what my losses should be. However, if I look up here, I'm just going to kind of point you to this number here and this number here are, if I add them both together and divide by 2, what I'm going to get is this number here. So why don't we try looking at it from that perspective? And if I do that, now what I see is I get 3.8%, which is exactly in the middle of this 3.6 and this 4.0. And it's kind of what I would do in the real world if I were faced with this particular situation. Now, obviously, it's not going to be as pure as this. In the real world, you'll see these numbers kind of jumping back and two, and the correlations may not be quite as strong. There still will be one, but it may not be at 97% as this one was. And I did this purposefully just so that you could see the kind of thought process that I would go through. If these numbers were all over the board, I might use some other statistical method to try to help me come up with a number, such as regression or whatever. Okay. So in this case, I'm going to stick with this number right here, which is 3.8%. And here is the amount that I would need for the entry. And as you can see again, this number is in between the 6.6 number and the 6.2 number, which is about where it should be, given that this number is in between those two numbers as well. So the uncollectible accounts expense in this case would be $243,600, and the allowance for uncollectibles would be credited in that same amount. Now here's the important part. Whatever you calculate for the entry, which is this number right here, that's an automatic calculation, that becomes the number that you're going to actually apply to your ledger. And I've kind of got a T account down here where you can see, I'm going to move this up just where you can see everything. And in scenario A, notice that you were supposed to have a credit balance to start with of $25,000, so I'm just going to put that number in. And automatically you see that what's happening here is my entry, which is right here, is the number that's going to go in here, and my balance will fluctuate up and down based upon the entry value, okay, and this beginning number. So that's all you needed for the first scenario A. In scenario B, what we've said is that the beginning balance in the account is $15,000. What that represents, by the way, is that if I have a debit balance to start the year, then that means that whatever I estimated last year was too low. And so I had $15,000 that I hit the account for beyond what I had estimated. The amount up here, the $25,000, means that when I estimated the amount, it was too high. I actually needed $25,000 less in bad debts in order to, or the allowance account, in order to fully fund the allowance of bad debts. Okay. So in this case now we have a debit here, meaning again that in this case I underestimated the amount of bad debts. And those are the kind of questions that you would see on a potential examination. Notice that the entry stays exactly the same. It did not change. It's the same entry as we had up here, even though we have a credit balance here and a debit balance here. And that's because we're calculating the amount based upon the current year's sales, or current year's estimated sales, and we're not, and it's the income statement approach, and sales is an income item, okay, and the expense is the income, is on the income statement as well. Again, my point is that those are income statement items, and that's what makes it the income statement approach, because the focus is on the income statement item, okay. And the allowance for doubtful accounts or uncollectible accounts, whichever you prefer, is a balance sheet item. And when we get to the balance sheet, you'll see why there's a difference, because in the balance sheet side, I'm going to stress this allowance or contra asset as opposed to the expense side. Okay. Now you can see that if you had a beginning balance of $25,000 credit, you would now have in the account $268,600. In the second instance here, if you had a $15,000 debit, after applying the same entry, which didn't change, because that's your expense, we only have $228,600. And depending upon how this whole thing works out, you would have to take a look and say, well, what were my actual losses, which I think I tried to do up here. And that would then encourage you to probably increase the account if you had a $15,000 debit to start. And if you had a $25,000 credit to start, you might choose not to do much with that account. Now, if it started to build up over time, then you are obviously overstating the amount that needs to go in the allowance for doubtful accounts. And of course, that on the other side is an expense, okay, to your business. So you're really recognizing more in terms of expense than you actually need to. And that is something that you may be cautious about doing, because you're going to understate your income. If you got too high, I think you would probably get some flack from the government, because remember, if you were doing that, then the government would come back and say, hey, wait a minute, you're taking too much expense and you're cheating us out of tax revenue. Unfortunately for us, the government has thought about that. So when you actually use the allowance method, you're using that for GAAP purposes. You would reduce your amount of bad debts by that $25,000 in this case, but you would then be able to increase it by the $15,000 in the other instance, because you are not allowed to take excesses on your tax return. Okay, that pretty much wraps this one up. I hope this helps you understand the income statement method a little bit better, and look forward to seeing you in class and working through this next problem with you. Thank you very much for your attention.